Welcome to the Cardano Virtual Summit 2020 discussion on future challenges for cryptocurrency exchanges. The cryptocurrency industry is replete with lots of different component parts. Obviously, there are various different blockchain protocols and lots of ancillary services, not talked about perhaps often enough, but sitting at the very, very heart of the blockchain industry and practical utility and services are cryptocurrency exchanges themselves. We're very, very lucky today to have representatives from two of the largest cryptocurrency exchanges, Binance and Coinbase, with us to discuss the future of the cryptocurrency exchanges. We've got Josh Goodbody, who is Director of Growth at Binance, and Zishan Farouz, who is the European CEO at Coinbase. Gentlemen, welcome.
Thank you very much. Great to be here.
Okay, to start with, what are some of the key regulatory challenges currently facing cryptocurrency exchanges?
Wow. Shall I kick off, Zishan?
Go ahead, Josh.
It's a big topic. Where should we start? Well, I think there are a number of challenges for cryptocurrency exchanges at a very high level. There is a complete absence, really, of a global understanding from a regulatory perspective, or a global standard, a harmonized standard at a global level of how crypto exchanges should operate. So that's the first challenge, right? And that's a historical challenge that the industry has faced. Now, when you look at that on a regional basis, even within a so-called single market, like Europe, for example, there are divergent regulatory approaches even within so-called single markets. So I think the main challenge that crypto exchanges face is navigating all of these component, bespoke and different crypto regulations or crypto rules in certain local countries. And navigating that is of course arduous, it's time consuming, but it of course means you're building different things in different places to cater to different standards. So I think that's the key concern and key challenge. It's the fragmentation of the regulatory approach to crypto assets across the world, let alone within a single market, such as, for example, the European Union. So that as a starting point, I think is probably the main challenge that we face as an industry. But then, there are various elements within that, of course, we can unpack.
I agree with everything you said there, Josh. I think that is, the fundamental challenge we have today. But to add to that, there are attempts today to try and bring some sort of harmonization at a global level. You have examples like FATF's recent guidance around crypto assets, but even those aren't without their challenges. Like there's this travel rule that they've introduced, and without diving into details around it, it requires a generally a very fragmented and quite a diverse industry to come together and agree on standards and build something that is truly global to comply with it. So I think the challenges are, as you said, Josh, that there is no harmonization even within single markets of regulation, and the few regulations that we are seeing at a more broader level, I think even rolling that out is a challenge given how the industry is structured today. And frankly, I do think personally, from a practical perspective, I feel that having a single global harmonized regulatory framework is something that Finance 1.0 didn't ever manage as well. And I doubt we'll ever manage, but it would be great for there to be some sort of convergence on, some good practices that can carry over across borders.
Yeah, I fully agree with that. And I think, we're seeing a lot of efforts out of things like, for example, voluntary member associations, local, kind of lobbying groups, which are super helpful in channeling the ecosystem's feedback to regulators and to different policy actors to steer people in the right direction. But as Zishan said, it's still super fragmented. To give you one really material divergence in just within Europe itself, the majority of Europe looks at cryptocurrencies not within the definition of a financial instrument, right? And that's important for various reasons, because if crypto assets did fall into the definition of a financial instrument, they're caught by a swathe of European regulation that is quite onerous and wasn't really bought for these kind of crypto spot instruments, right? Spot FX falls outside of it, so why should crypto spot instruments fall within it? However, the largest economy within the European Union, Germany, has taken the view that the majority of crypto assets, mainstream crypto assets, fall within the financial instrument category. And that's really interesting, because that's not only going against the grain of other European member states, it's also going against the grain of signals thrown out by the European community's policy thinkers, whether it's ESMA or other groups like that. So even within a market that's supposed to be really hand in hand and very much coordinated and harmonized, there's this massive divergence of practical approach to how to regulate these assets. And these approaches have actually fallen into law already. They're already implemented in, for example, Germany and in other member states, thanks to the fifth money laundering directive that was implemented earlier in the year here in Europe. So that's just one example, but that's a really material example, right? And that's within a so-called single market that should be treating things in similar ways.
Okay. There are issues around KYC regulations and know your customer regulations. On a global scale, then the way in which KYC and AML regulations are interpreted have essentially meant that lots of the big international finance houses and banks and providers of finance have arguably abandoned many areas of the developing world on the basis that it's not really possible to prove identity and records of potential individual consumer level customers. How would you like to see the KYC process amended and developed in order to better suit 21st century circumstances, and in particular cryptocurrency exchanges?
I could take a first stab at that. Reflecting on your question, I think there's one aspect of that in terms of the incumbents abandoning KYC in say certain challenging markets. I think there's more to it than the challenges around KYC alone. I think it also comes down to what's the ROI on KYCing somebody who may not have a lot of money. Like as a commercial business, you would I imagine any business with the right kind of profitability would look at KYCing anyone, regardless of what the challenges are. So I think some of it comes down to a cost-benefit analysis as well, and that's the kind of thing that we're trying to solve. I think the promise of crypto is to try and address that. I think KYC. So I guess the notion of KYC is to know who we're doing business with as an exchange. And I as a principle, I absolutely agree with that. We do not endorse or want to participate in activities that are illicit, illegal, or morally corrupt. So I think the idea of KYC in knowing who we're doing business with, and knowing that our platform is not being used for laundering illicit funds is something that is really a part of our core principles. Now, KYC as it exists today it's again similar to regulation. It's your ability to KYC someone ranges from easy in some developed markets like say the UK to other markets where you just don't have the right infrastructure. I think there's certainly ways to address that, and some are simpler than others. There's a lot of creative ideas that have come up around social KYC, or being able to piggyback off of actually telecom infrastructure, which in developing markets has very high penetration rates, and most phone holders have been KYC'd by their telecom providers. So, I think there's a lot of vacuum here for exchanges like ourselves to step into that, to embrace these less conventional KYC models, but that still give you a high degree of confidence and certainty on the people that you're interacting with, knowing who they are. Because ultimately, I mean, our goal is to create an open financial system as a business. And for us to further that goal, it has to be inclusive. It has to be accessible to every individual anywhere in the world. So I think, in short, the answer to your question is I don't think KYC is impossible. I think it's harder in some countries more than others. And it really comes down to us making the effort to ensure that we go out and bring those users who want to participate in the ecosystem into the fold.
Yeah, I fully agree with that. I think, our where we very, very much converge together is we both have a vision as companies of building this open and inclusive financial ecosystem. Our ethos is, we call it spreading the freedom of money, but with that comes responsibilities, right? Now, when we look at the developing markets or the emerging economies, when we've looked at the practical challenges of servicing those jurisdictions, in many respects, it does come down to how do we identify our clients there. And it's simple things like there might not be a government database kept of up-to-date address records, or there might be a challenge in, for example, verifying paper copies of identity documents. As Zishan said, for many companies, trying to define the ROI on that, it's just not worth their while. The value that many large corporations in the traditional financial sector would derive off those previously unbanked clients is very limited. Now, where we're coming from as an industry in the crypto space is very different. We're trying to create a new and improved open digital financial ecosystem. And the onus is on us as an industry to, jump over any hurdles that we encounter to get these unbanked people participating in this new economy. And we're right at the inception of that. But I think largely as an ecosystem, we're doing pretty well in meeting those challenges. And a lot of the challenges that are being slowly resolved, especially in these emerging economies, relates to technology around how you can KYC yourself, whether that means innovative things like, as Zishan referenced, utilizing existing KYC data sources, so telecoms companies, utility bills, etc., or even creating simple things like, for example, digital identity verification tools. So, for example, once you're KYC'd somewhere else in an ecosystem, your ability to passport that over to a new service provider and get up and running almost seamlessly. I think with the emergence of technology being able to store very, very sensitive information, confidential, sensitive, personal information in more robust ways, utilizing that in almost kind of a safe and secure way, leveraging blockchain technology, allows us as an industry to start offering services to people that previously wouldn't have been catered to. So we very much see that as one of our core missions. It's making sure our services are accessible to as much of the unbanked population as we possibly can. That's a challenge because they're already unbanked at this moment in time. Getting them to utilize a service that is so new, that is so complex in many respects, the onus is on us to make that journey easy. But it all starts with our ability to offer them that service. So from a Binance perspective, we very much see KYC as the beginning and the start of someone's journey. If we can find a way to get comfortable with them as a client or a user, well, then we can offer them a wealth of services. So for us, it's a core priority, always keeping an eye on emerging technology that's coming to market that allows us to do this better, quicker, and in more places. And that's really the key, because if we can do that, we can keep expanding our business and keep offering this suite of services to more and more people.
Great.
And adding to it, so to pick on one of the points Josh raised, I think the idea of decentralized identity is an extraordinary shift in how we operate today, because when you think about it, KYC today is again fragmented. You every time you open an account, you have to go through the same KYC process again as an individual, and to be able to imagine a world where you have a single decentralized identity, and that's an identity you carry with yourself from one place to another. I think that's incredibly powerful, because it it means even from simple thing, from a simple angle like data protection. Now, a copy of your passport is not held by 10 institutions. It's available in a single decentralized identity. I think that has the promise of making financial services or services that are gated behind identity much more accessible and making users' data safer in the future. So that's certainly a world that we want to push towards, and we hope we get to.
Yeah, same on this side. I think the inherent benefits of having that as the new model or an accessible model to people are transformative in many respects for a number of kind of segments of the economy, whether that's banking, cryptocurrencies, getting people kind of set up within, for example, local financial ecosystems, even if they can connect that to, for example, government bodies, government registers. Suddenly people can start getting set up with their local doctor's surgery much easier, or whatever it might be. So we're really keen to see that kind of technology develop over time. And even pivoting the conversation a little bit away from the unbanked, this solution will be very, very relevant for them, because it means they could get up and running in a much more seamless way with everyone else that has perhaps previously neglected them. But the existing developed economies, if you can look at the myriad scandals we've seen relating to large companies having data protection issues, this is really a way of giving people peace of mind that their identity is being kept and stored in a safe way. And as Ishan said, no one likes the idea of, in 1 year, KYCing with 5 or 6 or 7 or 10 different service providers in different jurisdictions with different standards. They've all got a copy of your passport. They know your address. They might even have your bank details. That for people is a real worry. And if we can, as an industry, push this in the right direction by saying, hey, we're open to these new technologies and we'll incorporate them as soon as they're up and running, I think that's, at least it's, the onus is on our part to help catalyze that.
It's great. It's really good to hear that major exchanges are pretty much on the same page as the more forward-thinking blockchain protocols as well. Certainly at Cardano, decentralized identity sits at the very heart of what we're doing. And I think earlier on during the course of this conference, we announced Atala Prism. It's the identity component, the identity element in a suite of enterprise-grade products that we're already working with governments and other organizations with, in order that we've got an identity solution that means that KYC requirements are satisfied. And as you say, it's something that's entirely portable, so stopping all of that repeated administration, and people can actually own their own personal identity. So that's great to hear. I'd like to move on to something which I think a lot of people, particularly people in the industry, will be interested in, and particularly people who companies that have their own blockchain protocols. And that is to try and get you to explain the criteria or the process that exchanges apply when they're considering tokens for listing. Now, traditionally this has always, I think, been seen as something of a black art, or certainly something that's opaque. I actually think that the reality is very, very simple. It's a confidential process, and if people knew precisely how it was done by each exchange, it's something that could be gamed. But could you speak in outline terms about what you go through and the process you go through when considering a token for listing?
Yeah, I'll kick off then. I think historically, I guess Binance has been pretty well known as being a venue, an exchange where you have access to projects that are being listed on a semi-frequent basis. So what we have done is spent a lot of time and thinking as a team internally on, what are the key pieces of information that we need to understand before we list a project. And what we tried to do is create a framework where we ask a pretty exhaustive bunch of questions, from tokenomics to, what's your risk, business risk assessment, to give us copies of your code or show us third-party audits of your code. And that process is fully disclosed on our application for listing page. So actually people can see the component steps that we go through when we're assessing projects for listing on Binance.com. Within that, of course, there are all kinds of proprietary things that we'll do to manage our internal kind of approach and process for listing that are super granular and very, very detailed. But at a very high level, it all comes down to quality. Is the project listing a token for the sake of listing a token, or is the token actually a core component part of that actual project and that business idea? What makes the token different to others? Is the underlying technology unique, or is it an improvement on something we've seen elsewhere? Is the intellectual property rights of this project unique? Is it protected? If so, how could you protect it? Has the project thought about that? How does the tokenomics of this work? I.e., is there a sustainable business model that underpins the entire rationale for them having a token? So we really, as an exchange, go into massive amounts of detail, and we have to, and it takes a huge amount of time. So one of the kind of, I think for all exchanges, one of the criticisms we all face is, why haven't you launched this? Or why haven't you done that? Why haven't you looked at this? Or you haven't responded to our community feedback on getting XYZ asset listed. And it's not for want of not doing it. It's just that it's simply a very, very long, laborious process for all exchanges. And different exchanges have different risk appetites, of course. And that means that the processes that they have to go through, especially the ones that are regulated in certain areas, are much more granular and meticulous than others. But at a very high level, I think the good actors in the space, the exchanges that are trying to lead from the front, are the ones that are taking their time to do a rigorous assessment of assets before they get listed on an exchange. So I know I haven't revealed any secret sauce, but I hope it's given a little window into some of the underlying thinking as to behind, why we take our time with listings.
Thanks a lot, Josh. Farouz, I imagine it's a similar process. Zishan, I imagine it's a similar process for you.
It is. So, and I think Josh touched on it slightly at the end of that comment there. I think there's another half of this story as well, which is regulation and the partner management that comes with it. So, and actually, to start off with, I'd say there's not a lot of secret sauce here, if any at all, to be honest. We actually, a couple of years ago, published publicly our asset evaluation framework. It should be out there if you look it up, which listed all the many factors that we would consider when we're listing an asset. And, I think we probably have been more conservative than other exchanges in terms of our due diligence and when we look at an asset, the types of markers that we're looking for. But the principle is the same. It's about ensuring that we have done our due diligence in the project. They are strong, legitimate projects. I have to be careful here, though, because I don't think, at least from our point of view, our role isn't to be kingmaker, over here. Our role is to just make sure we have a responsibility to our customers to expose them to assets that we feel meet a certain standard. Now, the other half of this is, so on the one side, you're assessing the asset, but on the other side, you have an ecosystem of partners, which include your regulators, your banking partners, your payments providers, who all have varying appetites and interpretations of different assets. So it very much is an exercise in positioning those assets with the right regulators, with the NYDFS, with our state regulators in the US, within the frameworks we have here in Europe, to make sure that the assets don't fall foul of any applicable law. We're in compliance with our licensing regimes. And then you also have your fiat partners, who again assess risk from their own regulatory lens, and working with them and making sure they're comfortable with the assets, the nature of use, the activities is another piece of it. So it really is quite a hands-on exercise to go from start to finish when you're assessing an asset, and to the point where you've decided to approve an asset, to then decide to work through getting your partner network on board supporting it. So it is quite an exercise, is what I'd say.
Yeah, no, absolutely. And I think over time we've seen the kind of underlying frameworks and information and kind of transparency of projects increasing over the last few years. So projects will often go to third-party, I guess you could call them auditors, really. I'm not talking about the technological side. I'm talking about the business side. They go to a third party that will review their underlying business case and their rationale, and they're looking at this as if you would look at any business, right? So going through all the component parts of the token and its associated use cases and the value proposition, and they're being able to produce these third-party reports. And so actually there's an ecosystem that's been built around the issuing or the token creation economy that now provides services to those projects or issuers, and gives them tools that they can use to be able to take those to exchanges like ours and say, hey, look, we've audited our code, we've done a risk report using a third-party auditor on X, Y, and Z. So it's been quite fascinating to see the emergence of these service providers coming to market, and it really makes the whole process of launching an exchange much more meticulous than it previously was. So launching a token, and it makes our lives as an exchange a little bit easier in that we can look to a wider range of information that's publicly disclosed. And that really helps. It helps us in our thought process as well.
And that's something. One thing I will add to that is that's something that we can do more broadly as well. In terms of, again, going back to the secret sauce, it's something we can do more broadly by helping regulators and other folks that work with assets understand the types of frameworks that are needed to assess a good quality asset. We started a group called the Crypto Ratings Council in the US, which was designed to do an assessment on assets to, from a securities point of view, and create like a unified industry view on whether something we deem is a security or not. So I think there's also room for these processes as this space matures. As Josh said, you can now get audit reports, and there should also be more widespread opinions that are shared and shared with regulators around how we see an asset, and therefore create a uniform view across the space.
Right. And it's good to know that despite this popular perception that the process of assessing tokens is opaque, mysterious, and non-transparent, the secret, if we can call it that, has been hiding in plain sight for a very long time, as the criteria that both exchanges apply has been hiding in plain sight, in that it's been published for a long period of time. So thanks for sharing that. I'd like to move on to the idea of staking as a service. Increasingly, there are proof of stake protocols and blockchains coming onto the market with their associated tokens. And the largest company, Ethereum, are of course themselves famously now moving across to a proof of stake protocol. More broadly, I think that in a societal sense, there is immense pressure on proof of work protocols to migrate across to proof of stake based protocols for pure and straightforward environmental reasons. I mean, internally, we often use the phrase that Bitcoin, for example, Bitcoin is Belgium in terms of the amount of annual electricity usage that's required to maintain that protocol with the large mining farms that are around globally. Where do you stand on staking as a service, and what do you think the future will look like? Are we likely to see significant growth in that area over the next 5-year time horizon?
I can take a first pass at that. I think staking is promising as a way to secure a network. I think it's still relatively, compared to proof of work, I think it's relatively nascent in the sense that you have Ethereum that is only beginning that transition. I know Cardano has a staking mechanism as well. I think it is quite ingenious in how it creates and balances incentive models without having to incur an expense, similar to how you do in proof of work. So there certainly is a future for it, a more environmentally friendly alternative to proof of work. I think staking as a service, so speaking about it from an exchange point of view, it's interesting because there could be different perspectives on this. The whole point of staking is for you to be able to participate in the network and have a stake in it. But when you're delegating that to an exchange, is that in the spirit of what staking is, and is it supposed to be like that? When I look at these questions, and when I look at the ambitions for some of these projects, let's say, you're ultimately looking at going out to quite a broad set of retail users eventually that will be interacting with these networks. And the reality of it is, most people don't care if something's decentralized or not. Most people don't care if it's staking or proof of work. They care about the value that's delivered to them. So I think staking as a service caters to a user base that, frankly, is getting value from the network or from that ecosystem in another way, and staking is something they're happy to delegate to an exchange. I think there'll always be a subset of users who simply don't want to actively participate in the network, and that's where an exchange, and this is, you can have the same conversation about custodial versus non-custodial. There will be, and this may not just even be exchanges, this may be more dedicated staking services, but I think there'll always be a place for exchanges and other providers to fill that gap, to provide a delegated staking service, and really to capture that value for the individuals that hold those tokens and return it back to them.
Yeah, absolutely agree. I mean, staking, as you say, I guess philosophically, the jury's out in terms of, is it to the core fundamental ethos of staking that someone could do it on your behalf? Well, for example, in the EOS network, the kind of pooling of staking rewards has been something that's been happening for a long, long time. So there's an inherent philosophical view that you could derive from it. But at the same time, if we look from an exchange perspective at different segments of clients, there are some that are super hands-on and savvy and understand what proof of stake means, are happy to hold them in certain wallets that have a staking functionality, or actually happy to do the staking themselves, do the heavy lifting associated with that. But there's a really large portion of clients that exchanges serve that simply are not interested in going out there and participating actively in these kind of things. So where people are taking the view to hold their crypto assets on an exchange for an indefinite period or just for a temporary period, whatever it might be, I think it's kind of a positive thing that exchanges are stepping up to the plate and going, right, well, what we'll do is we'll give you a delegated staking service, and you'll be able to hold your proof of stake assets with us and derive the network rewards from your participation. So passing that through, I think is very positive. If an exchange isn't passing them through, that's, I think, where consumers need to start thinking wisely, a little bit like, when you give your money to the bank, do you know what the bank is doing behind the scenes with your money? What are they doing? Are they rehypothecating it? Are they lending it? Yeah, of course they are. But at least with staking, you know exactly what's going on with your asset, how, and what rewards you're getting from it. So I think the more people that we can offer this staking service to as an industry, the better, because it engages people a little bit more in the kind of journey of understanding what these different assets are. And if we're really saying as an industry that we want people to start thinking of crypto assets as either a substitute in some cases, very niche cases, or an addition, supplementing their existing, for example, financial banking frameworks or whatever it might be. If we're saying that to people, we also have to give them the ability to learn about it. And in learning about it, you kind of need to be, involved in it. So giving people choice, I think, is really the key here. And then they will learn a little bit more about the ecosystem bit by experimenting and trying new things out.
I think the flip side to this is, and we're talking about this from an exchange point of view, but I think the flip side to this is it concentrates power in an exchange. It concentrates influence within the network, within an exchange. And when it comes to things like controversial decisions around, say, development of the protocol or something in the network, then that raises questions about the influence that an exchange yields, which may be driven by their motives rather than be representative of their constituents, their users. And I think that is a real risk. That is a challenge that will need to be solved. I mean, you could simply, a very simplistic solution to that would be that people do kind of vote via who they stake their assets with, so which exchange they hold their assets at, and that might become a position where, for decision X, Binance is voting with option A and Coinbase is voting with option B, and that might become a way of people deciding who and where their assets are staked. So it may ultimately become a choice for consumers make in terms of who they're aligned with when it comes to participation in the network. But there are unanswered questions over here in terms of concentration of power and how that can be used for political motives.
Yeah, I'd agree with that. I think there's, an inherent risk for the industry in concentrating power in the hands of a very small handful of operators, for example. That's, I guess, fundamentally not in line with this decentralized ethos that we're all, pushing or believing in. So it's a balancing act, absolutely. And I think as long as exchanges are transparent and communicative about what they're doing, I think that's really the key. If you're telling your consumers, when you're staking with us, this is how we will operate in X and Y scenario. I think it's that transparency and making users aware and fully up to speed as to how this thing works is really the key. And this is a new space for us all. So in that sense, again, the onus is on us as exchanges to build this in the right way and to communicate it in the right way to our users, because it's so new. And some of these protocols are new in the sense that they haven't gone through a material voting event that could change the course of the asset. And suddenly the question arises as to how a large block of voting power should be wielding its authority. So it is a real challenge, and I think it's also a reputational thing that exchanges need to bear in mind as they're kind of walking this line, providing these staking services. But it all comes down to transparency and communication. And in that respect, I think exchanges can always do better. We can always do better. Binance can. But I think we're all walking along the right path in giving users kind of that choice, and that choice is key for us.
Great, thanks for sharing that. It's surprising how many questions to do with exchanges are at their core philosophical questions. I think that often exchanges are seen as faceless functional entities, and people aren't aware that there are, some things around the fundamental ethos of blockchain are just as ingrained within exchanges as they are within consumers within the blockchain space as well. I'd like to move on to the responsibilities and expectations that fall upon exchanges. It strikes me that exchanges in some ways are stuck between a rock and a hard place, because you need to satisfy two very different audiences. Like all businesses, you need to satisfy your customers, but then in addition, you've got the additional regulatory burden of satisfying regulators. Can you talk us through some of the responsibilities and expectations that fall upon exchanges in both those respects?
Shall I kick off? It's definitely a challenging period of time, I think, for all exchanges when it comes to balancing, what we want to create for consumers and what we can create for consumers. Because ultimately, exchanges to have longevity, to be here in 3 years' time, 5 years, let alone 10 years, they have to be compliant insofar as possible. In as many respects as possible, And that's a real challenge. Now, I think the exchanges that are getting it right are the ones that are engaging with regulators, that are engaging with communities, whether those are, for example, voluntary associations, whether those are kind of consumer or industry groups, engaging with stakeholders, educating the regulators as to the reality and the nature of our business. And taking, for example, the UK as just one example of many. The FCA have been pretty hands-on with this. They've released consultation paper after consultation paper. Yesterday, they released a really interesting consumer report on the state of crypto assets in the UK. And that really shows a pretty sophisticated understanding of the cryptocurrency ecosystem. And that's because they've taken the time to listen and try and learn, not just from the participants, but also from the wider global ecosystem as well. Some regulators have been accused of acting too slowly. Others have been accused of acting too fast or not acting at all. I think some of the better regulators have taken their time to assess the long-term impact of regulation on the crypto asset industry in the lens that this is positive, right? The more regulatory certainty that we see as a company, the more it gives us the ability to offer new products and services in new places. So really, regulation for us is as commercial as it is legal and compliance driven. It's for us unlocking business in new areas. So we see a real impetus right now in the industry to participate and communicate with regulators. It's something that we are increasingly getting involved with as a company, as we kind of try and expand and take our global company more local. It's something we have a big appetite to do, and I think it does take its time, right? So it's not like we can say we're going to be licensed, regulated in every single country in 6 months' time, simply because of the nature of how regulation works. Licensing applications take a long time, feedback and discussion takes a long time. But the great thing that we have seen recently is that regulators are willing and open to have these conversations, understand a little bit about our business, and see, how to help foster development of these kind of industries in their respective economies. I think it's overall a pretty positive message.
I'd agree with everything Josh has said there. There's not really much, I think, left to say. I guess the only thing I'd add is, we try and, it's a balancing act as much as there's competing. Well, there's not entirely competing priorities here. It's about doing the right thing, and I think the intent for all sides is about doing the right thing, and it's about bringing everyone together to converge on here's what the right model of doing something a certain way is. So, at the risk of repeating what Josh has said, I agree with everything there, and I think it is a challenge that we try and solve for by finding the balance, educating regulators, working with them as much as possible, while balancing our commercial business needs and our customer expectations at the same time.
Right. Okay. And
you've got a very compliant panel today, Rod. Josh and I are agreeing.
Listen. Compliant is the way I like participants in these discussions, I assure you. Well, moving on to digital exchanges. Again, this is largely a philosophical question, really. The idea of a digital exchange, it could be argued, is more attuned to the philosophical origins and ethos of blockchain and the idea of direct peer-to-peer exchange. Does that conflict with the traditional model of crypto exchanges? As things stand, both Coinbase and Binance have managed to navigate a path where you've essentially got feet in both camps. What's your view on DEXs, and what's the future likely to look like?
Yeah, I can. So from our point of view, as you say, it's a great sort of philosophical challenge. You have us, a relatively centralized big exchange in a decentralized world, and that to some extent can be an oxymoron. I think the reality, the practical reality of where we are today is decentralized exchanges have promise, but there is a journey to get to a world where they exist. So they fulfill the decentralized. I think they're great at concentrating liquidity across different places. I think they certainly have use cases, and I can run through several of them, where I think a decentralized exchange could be better than a centralized exchange. But I think a lot of those use cases are in a world which has largely transitioned over to cryptocurrencies, to digital currencies, simply because a big part, and we've talked about this in this conversation earlier, a big part of our job today as an exchange is to act as this bridge between Finance 1.0. As for us, in our case, it's very much acting as an on and off ramp from the existing financial system into crypto. And what that requires is it requires a lot of compliance with regulation. It requires a lot of engagement with the right partners. And that's something that, it requires oversight, it requires controls, it requires fraud management. There's a lot of things that are baked into that for a centralized exchange does today, which don't translate very well or can't be translated to a decentralized exchange. So in my view, I think, in order for you to maintain those touch points with the existing ecosystem, existing financial system, you need centralized exchanges to act as the bridge between the two. In a world where all money is digital, I can certainly see there being decentralized exchanges that have real use cases and that act as the central hubs for where trade happens. But until that stage, let's say that's step 10 of 10 of 10, we're probably at step 2 or step 3 in that journey at this point. So I think there's a few stages for us to go through before we get to a place where decentralized exchanges can serve as as the core heart of the trading that happens in the decentralized world.
Yeah, I think it's great that we. It's funny we're talking about open financial ecosystems, but again we come back to philosophy, and it's inevitable with blockchain, right? It's inevitable that we have these discussions around, is what we are doing, is what they are doing, in keeping with the philosophical origins of Bitcoin and blockchain technology. But it is a question that we get asked a lot. Binance is a centralized exchange in many respects. Yes, it lists a bunch of decentralized assets, but the fundamental nature of the Binance.com core offering, where we came from, was from a relatively centralized offering. And that is, as Zishan said, that's because we need to create as an industry a bridge that works well. And that's the first step. You can't get people engaged in this industry if it's not cheap, easy to use, and reliable, right? And that really is where centralized exchanges come in. They work, they're scalable, they are easy to integrate with different fiat on and off ramps, card payment solutions, banking, deposit and withdrawal channels. That's quite simple to do now in a more centralized environment. Now, saying that, we as an organization are massively supportive of DEXs. So the idea of a decentralized exchange for us is philosophically exciting, especially for our founder who really lives and breathes this kind of stuff. He really adheres to the kind of core tenets of blockchain technology philosophically, and a DEX really does that. It gives people the ability to hold their own keys, manage and control their own assets, and interact with other people in the ecosystem in a decentralized peer-to-peer way. Now, saying that, yes, we do support DEXs, a DEX, the Binance DEX. It's taken time for the liquidity to ramp up on that. It's taken time for people to get comfortable interacting and trading on that decentralized exchange, simply because DEX user journeys are not as smooth yet, or as easy or as simple as the centralized exchanges that we have right now are. So looking at different segments of the crypto ecosystem, if you look at your average retail user that really wants to buy a couple of different crypto assets, maybe that's Bitcoin, maybe sell it now and then, but hold it for a good period of time, start experimenting in that cryptocurrency space. It's unlikely that as an ecosystem we'll be able right now to encourage them to hold their own keys, to fully understand what that really means, what they need to put in place to do that in a safe and secure way, and then trade it over a DEX, linking their wallet with a DEX. That's a challenge, and that will come with time, as Ishan said. Where things start to move into the digital space in a wholesale manner, and everyone is used to using a wallet in their day-to-day life, and that wallet can be linked to different services. There may very well be a world where DEXs become more and more important. In many respects, that might be quite positive, because you do reduce the systemic risk that we tend to see concentrating within larger exchanges. So, we'll see less of those big kind of reputational issues where an exchange in a country is hacked, for example. That has less of an impact if people are holding their own keys. So there are benefits and there are cons on both sides of the argument. But I think, we're in the exception stage of seeing DEXs roll out, and all the associated functionality that you would expect to see with a DEX is just starting to be built. And it's nascent technology. So I think until one, there's more adoption, and two, DEXs are slightly easier to use for your average retail user, at least we think that the majority of our activity will continue within our centralized infrastructure. But again, education, right? If you tell people about it, they'll learn about it and they'll give it a go and play with it. So, we're a young industry. We've got a long way to go, but I think we're all making pretty good strides in the right direction.
So the picture you seem to be painting, both of you, is one where DEXs will come into their own, or may come into their own, but perhaps ultimately only at a time when all national economies, all national banks have their own central bank digital currency, and there's a really broad brush approach to digitalization of currency and assets. And at that time, maybe we could see digital exchanges starting to dominate. But at this stage, we're at a point where we're trying to get people to migrate, or at least to start to experiment, as the word you use, Josh, with digital assets and using exchanges of any sort.
Right. And we're at the beginning of that journey. We've got a long way to go until it's an easy journey for people to use a DEX. And I think some great work is being done across the board in the industry to make DEXs more accessible, and at least from a user interface perspective, make it look and feel like a service that they're quite used to using right now. But we're right at the beginning of that journey.
And there's also other sort of parallel challenges to solve, and philosophical perhaps to address as well. One thing that I think is particularly interesting is self-custody, which is closely tied to DEXs, in the sense that I don't think most people would want to self-custody their assets simply because of the lack of user-friendliness of forgetting a password to, say, your Binance account or your Coinbase account. So I think there's more philosophical challenges there in terms of, figuring out what are the other parameters around a decentralized exchange, and how do we get people accustomed to them?
Sure. Well, we've had what I think is a surprisingly philosophical discussion. Certainly not something I expected, and something I don't think viewers would have expected. Can we just finish off by asking you both what you think the future will look like over the next 5 to 10 year time horizon? Because in reality, we've only seen the really rapid development of exchanges and an explosion in their functionality and their product offering over the last 5 years plus. what do you think the world will look like in terms of appetite for cryptocurrencies and use of exchanges over the next 5 to 10 years?
Wow. I get first if you want. I think there's two really significant developments that are happening right now. I think central bank-backed digital currencies is one of them, and then you've got projects like Libra. I think what we need is a sort of an event, is how I describe it, that that drives forward mass adoption, and that could be driven by. And I know this is controversial in the decentralized world, but a central bank-backed digital currency, or with someone like something like the Libra project, bringing in millions and millions of users into the fold. Depending on the timing of either of these, I think what that will usher in is a golden era for digital currencies, because I think as projects they might succeed, they might not succeed, but what they'll create is interest and a lot of infrastructure investment and development, which will impact and which will benefit decentralized currencies as well. So in a way, the way I think about it is central bank-backed digital currencies are great for Bitcoin, because it helps people. One of the biggest mental leaps to make is from your traditional concept of money to, let's say, a Bitcoin. But if you're halfway, you will be halfway there with a digital form of your pound or euro or dollar. It's a smaller leap to make towards other digital currencies. So I think depending on the timing of one of these major events in the next few years, that would usher a accelerated scale of development and infrastructure investment on digital currencies themselves, as well as native ecosystems with tokens that start to emerge. So I hopefully that happens in the next 5 years, and in 10 years, it'll be. I mean, it's unlikely, but I think in 10 years, if the best case scenario is that the traditional cash, traditional money would start to fade.
Yeah, I like that. Traditional cash starts becoming digital. I mean, if that happens in 10 years, that would be pretty remarkable. But it's very possible in some economies, I think. Absolutely. So to go back to your question, so we're celebrating our 3rd birthday on the 14th of July, right? So for us as a company to think 10 years down the line is challenging. But if I can put my kind of my stargazing hat on and try and think about where we might be in 5 years' time, as Ishan said, we're going to see these events that catalyze mass market awareness of digital assets. And if a company like Facebook, if and when a company like Facebook opens up its entire user base to the Novi wallet, which will accommodate the Libra currency, suddenly you have hundreds of millions of people around the world transacting in a wallet environment with each other. So the leap, to go to what Zishan said, the leap between using that asset, which I'm sure exchanges like ours would be very interested in listing, for example, the leap between an asset like that and Bitcoin and other crypto assets is very small. So that mass event, that mass kind of catalyst event is coming. We know it's coming. It's happening in Brazil, with Facebook as one example. Central bank digital currencies are growing, in terms of the list of countries that are looking to implement them day by day. And the more digital we go, the more people start to think about other digital assets that are out there. And if it's quick and easy to go from one asset to another in a digital format, it's inevitable that crypto assets will have a pretty interesting tailwind from which that they can, kind of launch themselves into other mainstream areas of the economy. So 5 years, it's going to be a very interesting space for us all, because a lot of what we're seeing now in the crypto economy as being niche or emerging will be much more mainstream and much more widely adopted.
True. Great. Well, gents, thanks for treating us all to a surprisingly largely philosophical discussion. It's been great to have you both being a part of the Cardano Virtual Summit 2020. I hope very, very much that both Binance and Coinbase will be involved with us in future events that we run. Thanks very, very much for taking part.